Okay, good morning. Okay, as you can see, there is a question in Learning Catalytics right now. We have Scribbles purchasing paper products on account from OfficeMax. So Scribbles is buying from OfficeMax. OfficeMax is obviously selling the paper. Which company has the accounts receivable? Accounts receivable is the asset. So when we talk about a company, accounts receivable is an asset. It represents money due from customers. So on this one, the question will be open for another couple minutes. I'm not going to announce when it closes, so you want to get logged in. If you're not logged in already, I will close it in a couple minutes at some unspecified time. So what's happening in this situation is Scribbles purchases paper products on account from OfficeMax. Which company has an accounts receivable? That is going to be the OfficeMax. Can you move the cursor on one? There, thank you. Okay, OfficeMax has the accounts receivable. In this chapter, we're talking about we talked about short-term investments on Monday. Today we're going to talk about receivables. And receivables are the amounts that are due from, typically an accounts receivable is an amount due from a customer. So OfficeMax is the answer. Again, if you're just joining us, you have a minute or two or so to get this question answered. I'm not closing it quite yet, but I am leaving it. Okay, so this week, Chapter 5 homework is due. We went over some of the homework problems on Monday. We'll do some today. And also this afternoon, I'll be emailing out about, I think, 3 short videos for homework problems we are not doing in class. But if you want to watch those, you can. They'll be step-by-step what we didn't cover in class. We covered the concepts, just didn't do the homework problems. So in this today, we're going to be talking about accounts receivable and notes receivable. And on Coca-Cola's balance sheet, balance sheets are in a very specific order. They start with cash, or they start with current assets, and the first current asset is cash. And then we have our short-term investments and marketable securities in there. And the next item down, the third item listed, typically the third category, is accounts receivable. And on Coca-Cola's balance sheet, they call it trade accounts receivable, and that's just saying they're selling business to business, and they've called it trade accounts receivable. Same thing as what we're talking about in here, trade receivable. And then it says less allowances, and we're going to talk today about what allowances are. So that's where we are today, is talking about accounts receivable. There's two types of main types of receivables we'll be talking about. Receivables are typically the third most liquid asset. So you're going to have your cash, you're going to have your short-term investments and marketable securities. They may be one line or two, but they're up there. And then you've got receivables. Receivables are money that's due to us from others. And there's two main types of receivables. There's selling goods and services, which are accounts receivable, and then lending money, which is notes receivable. And we're going to start with accounts receivable today. We'll end up class with notes receivable. The big difference between the two is notes receivable has a promissory note, and notes receivable carry interest. So there's interest on a note receivable. Okay. There's two main ways we can record receivables. When we have an accounts receivable, we are going to see when a company makes a sale on account, you're going to see the company debiting accounts receivable, crediting service revenue. That's the basic entry. I think we've seen that before in prior chapters. Same goes here. A notes receivable, typically a company is loaning money, and so when they loan money, they're going to debit notes receivable and credit cash because they're giving cash out. So those are the two main entries that create this receivable on our book. So we have accounts receivable, we have notes receivable. Accounts receivable typically arise from selling goods or services to a customer on account. Okay, some vocabulary. Okay, so we talked about, going back a couple chapters, that we have a general ledger. A general ledger is a listing of all of our accounts and the activity in our accounts. So a general ledger would have an account like accounts receivable on it. And in this case, we have accounts receivable with a balance of $9,000. Accounts receivable is an asset, has a normal debit balance, and right here, we have a balance of $9,000. That means that our customers owe us $9,000. Now, that's the general ledger. So the general ledger has this account called accounts receivable. So all the sales we make go in it on account, and then when customers pay it, they come out of it, and then we have $9,000. But we need to know who specifically owes us. The reason we need to know that for at least two reasons. Number one, we need to be able to collect from our customers. So we need to know how much each customer owes us and if they owe us anything. And number two, we also have auditors that come in. Our financial statements are subject to audit, meaning a third party comes in and verifies to the best of their ability that the numbers on our financial statements are correct, that we didn't just make them up. Now, they verify accounts. So auditors will come in. For your cash accounts, auditors come in. They will contact your bank, and the bank corresponds with the auditors directly and says, this is how much we have on deposit. So they can verify your cash account. Then the bank will contact your brokerage firms to confirm short-term investments and things like that. Now, the bank needs to be able to confirm accounts receivable, or the auditors need to be able to confirm accounts receivable. We can't just say, oh, our customers owe us this, trust us. Okay? We've got to be able to verify them. And we need to be able to collect from our customers as well. So we have something called a subsidiary ledger. A subsidiary ledger is the detailed account of what makes up the general ledger account. So we have a subsidiary ledger for accounts receivable. In our case here, we have three customers that owe us money. We have Brown that owes us $5,000, FedEx owes us $1,000, and Moody's owes us $3,000. So that's the detail of what our customers owe us. If we add those up, they equal the $9,000 that's on the balance sheet. So we say this is our subsidiary ledger, so whenever a customer pays us, we post it to their account. It's also posted to accounts receivable. Whenever we make a sale on account, it gets posted to the customer's account and to the general ledger. So the general ledger at any given time, the accounts receivable total balances to adding up all the subsidiary ledgers for accounts receivable. So know the term subsidiary ledger. It's a listing, a detailed listing, the detail behind what's in the general ledger account. Then notes receivable. Notes receivable, as contrasted to accounts receivable, notes receivable, we sign a written promise to pay. There will be interest on it, and there'll be a due date called a maturity date. So these are two different types of receivables, and we are going to do accounts receivable first. So, with accounts receivable, we have to worry about the collectability. We said, so if everybody paid us, we could skip the next most part of today, but customers don't always pay. We extend credit as a business. We're going to extend credit to our customers because it drives sales up. They did a study where businesses accepted only cash from customers and then they would accept credit cards. Accepting credit cards would triple or greater sales from a business because it facilitates purchasing by customers. Businesses are no different. If you say to a business, you're going to have to write me a check and pay me the day you buy something from me, your sales are going to be much lower. So as a business, you make a decision to extend credit. Most businesses extend credits. Now, there is benefits to selling on credit. Basically, your sales will go up. You'll have higher profits. So that's the good side of selling on credit. Now, the bad side of selling on credit is that the company will not be able to collect from some customers. Some customers, despite your best efforts, will not pay you. Okay? You cannot predict those in advance. If you could predict them in advance, you wouldn't sell to them. So it's just some customers are not going to pay. So you're going to have uncollectible account expense. Now, we would like, when we make a sale, we have all these sales in the period, we need to be able to recognize that some of those sales won't be collected. Some of those sales on accounts won't be collected. We have the accounts receivable on our balance sheet. So we have this asset. We need to say, oh, we're not going to be collecting for all of that. Some of that we won't collect for. So there's something called an allowance for uncollectible account, which is where we're going now. Okay. The allowance method says we know some customers aren't going to pay us. We don't know which ones specifically. If we knew, we wouldn't sell to them. So we're going to estimate how many won't pay us or how much is not collectible. We're going to estimate based on prior history, and we're going to set up an account called Allowance for Uncollectible Accounts. Allowance for Uncollectible Accounts is a contra asset. It's a contra account, but it's a contra asset. Okay, so you want to write this. You're going to have a question on this coming up, maybe once or twice today. Allowance for uncollectible accounts is a contra asset. Okay, so it's a contra asset. It's a contra account, but specifically, it's a contra asset. A contra asset means it's exactly opposite. So we might have accounts receivable of 100. We might have an allowance of 10. So the 10 gets subtracted from accounts receivable. They're opposite. Accounts receivable has a normal debit balance. Allowance account, because it's a contra asset, has a normal credit balance. A contra asset is always shown with its asset. So you will always see accounts receivable with its allowance. The allowance says, here's how much we think we're not going to be able to collect. Because on our balance sheet, we don't want to show 100, for example, as our asset if we're only going to be able to collect 90 of it. We don't want to overstate our assets. We don't want creditors and investors relying on assets that really aren't there. So we do this allowance method. Now the allowance method is what's acceptable under generally accepted accounting principles. Okay? And the allowance method says we are going to estimate how much in any given year, how much we're not going to be able to collect. Okay, so the allowance method. When we use the allowance method, what you're going to see on the balance sheet is you're going to see accounts receivable less the allowance for uncollectible accounts. You will see it just like this. You will see the accounts receivable, then you will see the allowance account, and the allowance account will have parentheses around it. It has to have parentheses around it. It shows that it's subtracted from it. So our net accounts receivable is $475. So the accounts receivable is what all our customers owe us legally, and then the 25 is our best estimate of what we're not going to be able to collect. So the net accounts receivable is $475. That's the balance of our that's our net accounts receivable. This is another way that it can be shown on a balance sheet. Some companies say, well, we're not going to show two lines. We're not going to show accounts receivable and allowance. They can do it in one line. They can say accounts receivable, net of $25 allowance, and just put the $475. So if you wanted to know their accounts receivable balance here, you would take the $475, add the allowance, and you'd be back to the $500. This information, companies can choose to do either way, whichever one they want. But companies using generally accepted accounting principles have to use the allowance method of accounting for this. So, okay, now there are two methods. When using the allowance method, there are two ways or two methods to estimate uncollectibles. You need to know both. We're going to have a question coming up here about what are the two methods to estimate collectibles. The two methods to estimate collectibles are the percent of sales method and the aging schedule. Okay, so the percent of sales is we take a percent of sales each period, the percent of sales each period, we're just going to say, here's our sales that were on account. We're going to take 2% or 5%, whatever percentage that we historically have used or that history says that we should use. And that's referred to as the income statement method. The reason it's referred to as the income statement method is that we're taking the sales revenue, which is on the income statement, and taking a percentage of it and saying, here's our expense. Here's our uncollectible account expense. So that's the percentage of sales. We're going to do a homework problem today that uses the percentage of sales method. The other method is the aging schedule. The aging schedule calculates what the allowance should be based on the composition of what we're owed, and I'll show you an example of that coming up. The aging schedule is known as the balance sheet method because it looks at the accounts receivable on our balance sheet or in our subsidiary ledger and says this is what the allowance account should be. The percent of sales method says here's what our expense should be. That's why it's the income statement method. The aging schedule looks at it and says here's what the allowance should be, and that's on the balance sheet. So that's why they're known by what they are. Okay, so we have the two methods to calculate, estimate our uncollectibles. Okay, now, the percent of sales approach, that's just a duplicate of what I just had. Hold on. Okay, so percent of sales method has an equation that we can use. And it's really a straightforward equation. We'll be taking the estimate of the percentage uncollectible times our sales revenue to give us our uncollectible account expense. Okay, so it's just taking a percentage of our sales. That's why it's called the percent of sales method. Okay, so the percent of sales method, we take this uncollectible percentage. So this percentage in your homework will all be given to you. But what companies do in real life is they look at their past history of what they weren't able to collect and calculate this percentage, and then they use that percentage going forward. So they take their percentage times their sales revenue, come up with the uncollectible account expense. The other method is the aging schedule method, but before that I'm going to throw a question in here. Okay, so we're talking about this allowance for uncollectible accounts. What is it classified as? A contra expense account, a contra revenue account, a contra asset account, none of the above. Get your answer in as soon as I deliver it. There you go. Okay. Allowance for uncollectible accounts. Allowance for uncollectible accounts, this allowance account, we said it's a contra something. Okay? It's always shown with accounts receivable, so it's going to be a contra something. What kind of account is accounts receivable? This is going to be a contra something. I'm going to close the question in about 10 seconds, so make sure you have your answer in. Okay. Allowance for uncollectible accounts is classified as a contra asset account. Accounts receivable is an asset. Allowance for uncollectible accounts is a contra asset. They are always shown together on the balance sheet. Okay, the other method is the allowance method. And the allowance method takes a few more calculations. The allowance method is going to take the percentage uncollectible times the accounts receivable balances. Now, this is known as the balance sheet approach because we're looking at the balance sheet. We're looking at the balances of accounts receivable. When we did the, let me go backwards one thing here. When we did the percent of sales method, we're taking the percentage of our sales. Sales are on the income statement, hence an income statement approach. Now we're dealing with the aging of receivables method. This is the percentage collectible. Okay. So the estimate of percentage uncollectible times the accounts receivable is going to give us this uncollectible account, allowance for uncollectible accounts. So we're focusing here on the balance sheet. So what we're going to see is when we do this, and you don't have to do this, what I'm showing you right now is Exhibit 5.3 in your text. What we do is we take our entire accounts receivable and our entire accounts receivable, and we break it into how many days past the invoice date. So we're basically saying how far past due are each of these accounts. And what we'll do, you'll see they change the percentage uncollectible based on how far past due. By the time you get out of here to over 90 days past due, you're using a really big uncollectible percentage. That's because the longer something goes past due, the chances of collection are falling rapidly. So when we do an aging schedule, you age your receivables, which simply means put the amounts due based on how far past due they are, and then you're going to take percentages of each of those buckets. We are not doing this particular calculation. I just wanted to show you what gets done behind the scenes here. So the aging schedule says how far is everything past due, and we're going to apply different percentages based on how far past due. Okay, so now we're going to do short exercise 5.8. Short exercise 5.8 says we have a company during its first year of operations. The company had sales of $483,000 all on account. Okay, so they had sales of $483,000. Industry experience suggests that their uncollectibles will amount to 2% of credit sales. Okay. So 2% of the 483 is going to be uncollectible account expense. At December 31st, accounts receivable totals $49,000. The company uses the allowance method to account for it, okay? So in part one, it says make their journal entry for uncollectible account expense using the percent of sales method. So the percent of sales method is one of two methods used to estimate uncollectible accounts. So when we do this journal entry for uncollectible accounts expense, it's always going to look like this. We are always going to debit uncollectible accounts expense, and we are always going to credit the allowance account. And the amount will be the percentage times the credit sales. So the $483,000 times 2%, $483,000 times the 2%, we're given the percentage, so we get $9,660, and we get a credit, credit allowance for uncollectible accounts. So whenever, this is an adjusting journal entry, and whenever you do the adjusting journal entries, you're going to be debiting uncollectible accounts expense and crediting the allowance account. Okay, uncollectible account expense goes on the income statement. The allowance for uncollectible account is it's a contra asset. The contra assets go on the balance sheet. It belongs with the accounts receivable. Okay, so that's the journal entry, and then the next part of this says let's see how they should report their accounts receivable on the balance sheet. So on the balance sheet, we're going to have accounts receivable less the allowance gives our net accounts receivable. Notice that our allowance has brackets or parentheses around it. You have to have that because the allowance account is a contra asset and it reduces assets. It specifically reduces accounts receivable. One more term. You should write this in your notes. You'll have a question on it and you'll also see it on the exam. Net accounts receivable is also known as net realizable value. Net realizable value is accounts receivable minus the allowance account. Okay, so net realizable value is accounts receivable minus the allowance account. Net realizable value. That's important to know that term because that term specifically refers to accounts receivable minus the allowance. It's basically saying, here's how much cash I expect to realize from this asset is where that's coming from. So net realizable value is accounts receivable minus the allowance account. Now notice in this problem, we did the percent of sales method. That was how this company estimated its uncollectible accounts. So we had the percent of sales method, and the other method is the aging schedule. We're not doing the aging schedule specifically, but those are the two methods used to estimate uncollectible accounts. So we have percent of sales and the aging schedule. Okay, so, and we have net realizable value is your accounts receivable minus your allowance account. Oh, guess we're at another question. Okay, there are two basic ways to estimate uncollectibles, the direct write-off method and the allowance method, true or false. I'm asking about the ways we estimate uncollectibles. We just did one, we just used one method in the homework probably just did. One of the methods, I'll give you a huge hint. In answering this question, one of the basic ways to estimate collectibles is the percent of sales method. So if you know that, you should be able to answer this question and tell whether this question is true or false. Two ways to estimate uncollectibles. One's percent of sales method, and then the other one is something else. So you should be able to tell if this is true or false. Okay, so I'm going to be closing this question. So again, right now 20% of you have this wrong. So listen, so when I'm telling you that there's two methods, okay, so there's two basic ways to estimate uncollectibles, okay? So I'm telling you one of them is percent of sales. So since I tell you that one of them is percent of sales, and I look here, the direct write-off method and the allowance method, neither one of those is percent of sales. So this question cannot possibly be true, right? Because one of them is percent of sales, the other one happens to be the aging schedule. So I'm closing the question. So that is false, okay? Percent of sales and aging schedule method. Okay, now more specific terminology. So a lot of these words sound the same. The next thing we're going to talk about is writing off an account. Now, write off an account is very specific terminology. Writing off an account means that we have found an account that is not going to pay us. We've identified a customer who is not going to pay us. Maybe they've gone bankrupt, maybe they've disappeared, but they're not going to pay us. So for our example here, we're setting up these accounts. So these are just numbers pulled out of the air. We have a company that has accounts receivable, 3 customers. customer RS is just the customer's initials, means nothing. We have accounts receivable from TM. Again, TM is just a customer, means nothing. And then everything else, 11,016. So those are accounts receivable. The allowance for uncollectible accounts is 98. So total accounts receivable is those three added up, 11,028. Allowance for uncollectible accounts is 98. So our net accounts receivable is 10,930. Okay? So net accounts receivable is accounts receivable minus the allowance account. It's going to give us net accounts receivable, also known as net realizable value of accounts receivable. Okay, so those are our facts. So those are all just given to us. So next, now early in the year, now that we have all these balances, okay, so we go into the year, and early in the year, we determined that that customer RS, that first customer accounts receivable, that 9, that customer can't pay us. They're never going to pay us. They've gone bankrupt, they've disappeared, something, so they're never going to pay us. So what we need to do is we write off this receivable. Write off is a very specific term. What we're doing is we're taking that receivable out of accounts receivable and out of the allowance. When we identify a customer who can't pay us, we say, aha, here's one of those customers that we estimated for. So it's not like we have new bad debt, new uncollectible account expense. We say, this was part of what I was estimating when I set up the allowance. So what happens with this is when we identify a customer who cannot pay us, we're going to say we're going to write that off. So we are going to debit the allowance account. What we're doing is we're taking it out of the allowance account. We're taking it out of accounts receivable. So what we've just done here is we've increased assets by debiting allowance, and we've decreased an asset by crediting accounts receivable. So we have zero impact on the balance sheet. We have zero impact on the income statement. So when we identify someone and we write them off, we're saying that this is one of the people that we estimated when we set up the allowance account in the first place. It's part of that. So it doesn't affect our income statement at all when we write off an account. Very specific terminology. We write off an account. So when we write off this account, we're debiting the allowance account, we're crediting the accounts receivable, and what happens, my lines are off a little bit, what happens is we'll debit the allowance for uncollectible accounts expense, we will credit accounts receivable, so we end up with a balance of 0. So what's happening here, I apologize, my number's off, this 9 right here, somehow, is up there. So we have a 9 debit, a 9 credit. We have a balance in accounts receivable of 9. And then over here in uncollectible accounts, this 98 is actually just up here. It's not on the line. So the balance of uncollectible accounts turns out to be 89. Yeah. So the balance of uncollectible accounts is 89. So what we get from this then is we end up with total accounts receivable after writing off the account of 11,019, total allowance for uncollectible accounts of 89, so we get net accounts receivable of 10,930. So it's exactly the same before and after we write off that specific account. So when you write off an account, it has zero impact on your income statement. It doesn't get charged to anything. It doesn't go to expense. It simply is taken out of our estimate. So on here, the balance sheet, the top half is the balance sheet before the write-off. We have accounts receivable 11,028, allowance of 98. So we have net accounts receivable of 10,980 and 930. So when we write off an account, we're taking it out of accounts receivable. We're taking it out of the allowance account. So the net accounts receivable is the same under both after we write off an account. But that is writing off an account. So writing off an account is a very specific terminology for identifying accounts that has gone bad. So when we write off an account, there is zero income statement impact. I'm going to answer that one because that's an excellent question. Do you mind? I'm sorry. Okay, I'm going to answer the question in the chat room. I can't resist. Sorry, I've done really well for a couple weeks. Okay, the question from William is, what if the account you write off has a higher value than the allowance for uncollectible accounts? That's a good question. It seldom happens. But if it happens, you have to do another adjusting entry, and it's way beyond the scope of our class. So it's not going to happen to us. And if you're an accounting major, you'll learn about that in a later class. But you do another adjusting entry then. Okay. So is that okay? Okay. Okay, so next question up. Okay, the net realizable value of accounts receivable is the difference between accounts receivable and what? Check your notes on this one. Net realizable value is your is the same as accounts receivable net or net accounts receivable. It's the difference between accounts receivable and the account that we keep talking about here. Okay, I'm going to close this in about 10 seconds. Okay, the net realizable value of an accounts receivable is the difference between accounts receivable and the allowance for uncollectible accounts. Okay, that's what's on your balance sheet. Your net accounts receivable or net realizable value is the accounts receivable less the allowance account. Okay, so I've got it in a little note there. AR abbreviation for accounts receivable minus the allowance is our net realizable value. Okay, we're going to do one more question right now before we move on. Okay. The allowance for uncollectible accounts normally has a credit balance. Okay, allowance for uncollectible accounts. Allowance for uncollectible accounts is a contra asset, meaning it's exactly opposite of an asset. So an asset has a normal debit balance. The allowance for uncollectible accounts is the opposite. It's a contra asset, means it behaves exactly opposite or backwards. So if the accounts receivable, an asset, has a normal debit balance, then the allowance for uncollectible accounts, which is a contra account, is going to be the opposite. We're going to close this fairly soon. You've got two choices. And again, the allowance for uncollectible accounts is a contra asset, meaning it is exactly opposite of an asset. So if you have that debit credit handout, which you should have every day, this would be the exact opposite of a normal asset account. And an asset account has a normal debit balance. This is a contra asset, so it's going to be exactly opposite. Okay. This is true because the asset has a normal debit balance. A contra asset has a normal credit balance. So this is true. The allowance account is a contra asset. Okay, now we're going to, I think we've got one more slide having to do with receivables, and then we'll move on. Okay, very specific. Now we have the direct write-off method. So this is not the same as writing off an account. This is a direct write-off method. The direct write-off method basically says, we're not going to do any of this allowance method. We're not going to estimate, and we'll just wait until we identify someone is not paying us, and then we'll deduct it. That is not generally accepted accounting principles. You're not allowed to do that. You want to estimate your uncollectible account expense as you go. So as you do business, as you have sales, you want to estimate uncollectibles. And we're required by generally accepted accounting principles to use the allowance method to estimate. Now, the direct write-off method says we're not doing any estimating. We're just going to wait until somebody can't pay, until they declare bankruptcy or disappear. The reason we're talking about this is for your tax returns, you have to do the direct write-off method. So this is a case where generally accepted accounting principles and tax principles are completely opposite. And the reason that happens is federal income tax, the tax code was written so the government can generate revenue. The government needs revenue to operate, so the tax code was written to say this is how much we want to collect. So the tax authorities are concerned with collecting taxes and calculating how much is due. Whereas generally accepted accounting principles for financial reporting is concerned with what information is valuable to investors and creditors and what information contributes to making a good realistic financial picture. And the allowance method is the method that makes more sense from a investor and creditor standpoint of important assets, knowing that you're not going to overstate your assets, for example. So the taxes and financial reporting have different purposes, and that's why they can be different. In this case, they are different. But the direct write-off method, direct write-off refers to a method where you don't have any allowance account. It is not the same as writing off an account. The terms sound very similar, but they are different. Okay, and with that, we're going to leave accounts receivable, and we're moving now into notes receivable. So accounts receivable are generated when we sell to our customers and they owe us. Typically, 30-day payment, somewhere in there. Notes receivable have a formal agreement. There'll be a promissory note where the borrower agrees to pay and there will be interest. So that's where this is different. So we've got new terms here. We have creditor, the party to whom money is owed, the lender. Okay? So creditor is who loans the money out. Okay, so the debtor is the party who borrowed the money and owes the money. The debtor is also referred to as the maker or borrower. Okay, interest is the cost of borrowing money. The interest will be stated as an annual percentage rate. So when you see an interest rate, even if it's a 6-month note, it's stated in annual percentage rates. The maturity date is when the debtor must pay the note. The maturity value is the principal plus the interest. Okay. Principal is the amount we borrowed, and term is the length of time. Notes receivable can either be current or short-term or long-term. Current means they're due within a year, long-term more than a year. I want to point out a couple things you need. Well, you need to know these terms, absolutely. The creditor, know that the creditor is the lender. Know that the debtor is the borrower. Okay? Maturity value. Here I want to jump up and down. Maturity value is the principal plus the interest. It's what the borrower is going to pay at the end of that note. So you want to put a little star, but it's the sum, meaning we add the principal plus the interest. Emphasis on plus, right? Because maturity value, it's what the borrower is going to pay at the end. They're going to pay the principal back, and they're going to pay all the interest back. Okay, now so I have a question coming up here. Okay, so the party, I've got a question out there, even though it's not showing on the screen right now. The party to whom the money is owed is what? It's who? The party to whom the money is owed is what? Okay. The party to whom the money is owed is which party? I'm going to close this in about 10 seconds. Okay, and it would be the creditor. Okay, now we're going to talk about some more about that terminology in the accounting for notes receivable. Okay, so this is a note. This is Exhibit 5.5 in your book, and we're going to do an exercise using this information, but I just wanted to point it out. A promissory note typically has the amount that you borrowed, which is the principal. It has the maturity date on it. It has the interest rate. That'll all be stated on the promissory note. So what we're going to do is this promissory note here is given it's $1,000, 9%. It's due February 28th. It's made August 31st, so it's a 6-month note. So this is, Lauren signs the note. Continental Bank gives her $1,000 cash. So we are doing the journal entries for Continental Bank. Continental Bank has the note receivable. So the date that Lauren takes the money, the date that Lauren signs the money, the bank writes a journal entry to debit notes receivable because now they have money due from Lauren, and then credit cash for $1,000, and that's to make the loan. So the bank's making the loan, and Lauren is getting the money, so the bank debits one asset and credits another one. Now, on the next, this is August 31st. We never charge interest on the date we make a loan. And for, I think, just about everything we do in here, unless stated otherwise, we do it in whole months. So it's always going to be based on months, total months, not number of days. So Continental Bank earns revenue, and December 31st, it's the end of their year. Continental Bank has to recognize that it has earned interest revenue on this loan. Even though Lauren is not going to pay the interest or the principal until February 28th next year, the bank has earned interest during September, October, November, and December. So to calculate the interest that the bank has earned, down at the bottom here is the formula. We have principal, interest rate, time, and amount of interest. So the principal is $1,000. That was the amount of the note. The interest rate was given as 9%, and the time, now this is important, it's number of months. We're talking about December 31st. The note was made August 31st. So we have 4 months, September, October, November, December, out of 12. The interest rate is always stated as an annual rate, so you have to adjust it. So this is 4 months out of 12, and the amount of interest then is going to be $30. So that's the $1,000 principal times the interest rate times the number of months divided by 12. So our journal entry at the end of the year is going to debit interest receivable and credit interest revenue, and that's one of our adjusting entries for accruing interest revenue. Yes. The question is, if it's a 6-month note, why is it out of 12? The interest rates are always expressed on an annual basis. So when you see that 9% interest rate, that is an annual interest rate. On notes, they always express it. I mean, I've never seen a note that isn't expressed on an annual basis, because that's a common, we can compare interest rates like 9% interest rate. That means something. But the note can be a 6-month note, but that interest rate is still going to be an annual rate. Okay? So good question. Thank you. Okay, so now we've accrued interest at the end of December. Lauren doesn't pay the bank back till February 28th, so we had to accrue the interest revenue. So what we see at December 31st is on the balance sheet, there's now 2 assets related to this note. We have the note receivable, the original $1,000 that the bank loaned her, and then we have the interest receivable, the $30 that the bank just accrued for. And on the income statement, the bank will have $30 of interest revenue because they had this loan outstanding for 4 months. So that's what's happening at the end of December. So now we're going to fast forward into the end of February now. So now Lauren is going to pay back the note. So the bank at this point has the note receivable on its books and the interest receivable. So, okay, so on February 28th, what the bank is going to do is it's going to collect cash from Lauren. Now, the amount of cash the bank collects is the maturity value. The maturity value is the amount of principal borrowed plus the interest on the note. And the interest on the note is going to be the $1,000 times 9% times 6 months out of 12. Again, notes always have their annual rate. So the maturity value is the principal plus the interest. So we'll have the cash of $1,000 plus 9% of 1,000 times 6/12. We'll see that in a minute too. Notes receivable, they're going to credit notes receivable to wipe out what Lauren owed because she doesn't owe it anymore. She just paid it off. We're going to wipe out the interest receivable of $30 because she doesn't owe any interest anymore. She just paid it all. And then we're going to recognize interest revenue for January and February, and that will be the $1,000 times 9% times 2 months divided by 12. Again, we're at January and February. So we recognize 4 months in 2014 and now 2 months in 2015. On all of these interest problems that have interest on them, we're going to be, that has an annual rate, so you'll usually need to convert it to months. I don't know if we have any with days in them or not, but it'll tell you if it's days, but typically we just use months. And you don't have to go with fractional months. It'll be full months. Okay, so again, when we're talking about notes receivable, the rates are usually, cannot think of an example where it's not expressed as an annual percentage, and a fraction is used for time periods less than a year, so the number of months divided by 12. If you have a number of days problem, it's a number of days divided by 365. Do not use 365 unless you're specifically told to use days, or it's only in days, it only makes sense to do days. We'll be doing months. So don't convert months to days. So use the months. Okay, then I've got a question coming up here. Okay, maturity value of a note is the sum of the principal less interest due at maturity. True or false? I guess I'm missing my true or false in the slide, but this is true or false. Okay, let me call your attention to this. We went over maturity value, and maturity value has principal in it and interest, but the important word here that your whole answer will hinge on is what? On this particular question, the maturity value of a note is the sum of the principal less the interest due at maturity. Is that true or false? The key word is less. And without even looking at your notes, think about it. Maturity value. Maturity value says what the person that borrowed the money is going to pay at the end. So if you borrow money from the bank and you go to pay them back, are you going to pay them back what you borrowed, the principal less the interest? Or are you going to pay them back what you borrowed plus the interest? And that's where the answer hinges on this, is watch very carefully that word less is thrown in there. Okay, closing this in 10 seconds, get your answer in. Again, think about it. Does someone pay back principal less the interest? Okay, that is false, of course. It's maturity value is the principal plus the interest. So important to watch for little differences in wording. This is just like in real life. If you sign a contract, one word can make all the difference in the world. So what we're going to do right now is we are going to do homework problem, short exercise 511, and this is calculating interest. What we have is we have a note on May 31st. The bank lent Ron $220,000 on a 2-year 5% note. Okay, 2-year 5% note. That 5% is an annual rate. So that 5% is 5% per year. So on May 31st, 2014, the bank loaned Ron $220,000 on a 2-year 5% note. So the requirement is to compute the amount of interest during 2014, 2015, and 2016. Invariably, the questions I get on this homework problem have to do with the number of months. So you have to remember in 2014, the loan did not occur till May 31st. May 31st, we don't count May 31st, so the loan was made for June, July, August, September, October, November, December, 7 months. So for 2014, we're going to take that $220,000 times the 5% times 7 months out of 12. Okay? Because the loan was outstanding 7 months. You don't count the day the loan was made. We're going with full round months. And the interest rate on notes, anytime you take a note or a loan out, the interest rate is expressed on an annual basis. So they're saying, what's the interest for 2014? It's 7 months of interest. Then for 2015, what we're going to do there, that one's easy. This is a 2-year note. So it was outstanding the entire year in 2015. So we have $220,000 times 5%. We can times it by 12 over 12, but it's going to be the same, but it's for a whole year, so it's really easy. 5% times $220,000 gives us $11,000 interest for 2015. And then finally, 2016. 2016, this loan would have been paid back at the end of May. So 2016, the loan is only outstanding for 5 months. It's outstanding for January through May. That's 5 months. So we're going to have the interest of $220,000 times 5% times 5 months out of 12. So if you add up all those months, so 2014 we had 7 months. 2016 there's the other 5 months. So we have 24 months total between 2014, 15, and 16. Don't be afraid to write the months down in the margin when you're calculating the number of months, or count them on your fingers, because it's easy to get confused. And that's the number one thing I see wrong on these things when I get questions about them. It's not realizing it's a different number of months. Like your problem might be only 4 months or 5 months. It might be 4 months and you're using the months here from class. It can be different, so watch that. Okay. Next up, which party has a note receivable and which party has, so a note receivable, who loaned the money? That's the bank, right? Okay, so the bank loaned the money. Okay, the bank loaned the money, so it has a note receivable. So who has the note payable? That's going to be Ron. Okay, so we have a note receivable and a note payable. They exactly mirror each other. So we are doing notes receivable, the asset, in this chapter. When we get to liabilities, you're going to see the exact same thing happening on the liability side, just a mirroring. Who has interest revenue? It's the person, the company that loaned the money. So it would be the bank has interest revenue. And then who has interest expense? It will be Ron, because it's the person that borrowed the money. So we go back and forth between the bank, Ron, bank, Ron. So the bank has a note receivable and earned interest. Ron has the note payable and pays interest. Okay. So, third part. Now, forget everything we've done to this point. It's giving us a new set of assumptions. How much in total would Main Street Bank collect if Ron paid the note off early on November 30th, 2014? So what's happening here is Ron took out the note on May 31st, 2014, comes to November in that same year, and he pays off the note. And it's asking, how much in total does Ron pay? So Ron's going to pay two sums of money as one, but he's going to pay the principal back. Don't forget the principal. He owes the $220,000. But he's also going to pay interest, and he's going to pay interest based on the amount of time that the loan was outstanding. In this case, we had June, July, August, September, October, and November. So that's 6 months. So what we're going to see here is the interest will be that $220,000 times the 5% rate times 6 months divided by 12. So he didn't hold it for the whole year. He just held it for 6 months, and he paid it off. So when he pays it off, November 30th, he's going to pay the principal of $220,000 plus the interest for the 6 months. Again, this right here and all the homework this week, this particular part right here is the one that I'll get the most questions about, because sometimes it's just as simple not getting the right number of months or thinking it was the 7 months we just used. So watch the months carefully. It can be different on your homework. You may get the same number of months. It may be different, but that's why we're doing that. So the total payoff will be $225,500. You know, if you pay off the loan, you pay off the principal plus the interest. Okay, now, the next, I've sent out a question, so I've answered. The creditor has a note payable. Okay, so our creditor, the creditor is the person who's loaning the money. The creditor, you can think of the creditor as the bank. Okay, so the bank loans the money. True or false? The creditor has a note payable. Is that true or false? Okay, so the creditor is the bank. So think about this. The bank loans the money out. So the bank is owed the money. The bank doesn't owe the money to someone else. Someone owes money to the bank. Does the bank, the creditor, have a note payable? True or false? As one further hint, right now, 86% of you have it right, which is great. A note payable is a liability. It's a debt. When we're talking about a creditor, we're talking about the person that loans the money out. We're talking about the bank. The bank makes loans. So when the bank makes a loan, does it have a note payable? I'm going to close this in about 10 seconds, so get your answer in. The creditor is the lender. Does the lender have a note payable? Okay, and that, of course, is false. Majority of you got it right. That's good. And that brings us to the end of class, 4 minutes early. So Chapter 5 homework is due this weekend, and have a nice weekend.